From Nvidia to Supermicro to Applovin, people have made a ton of money betting on AI companies. And for new investors, the question I hear more often than not is, am I too late? We are at a critical junction in global development, and dare I say, money is going to be made that has not been made in the last 17 years. And if at this stage you're still betting against AI, I would love to take the other side of the bet. But before the boom, there would likely be a crash, and that's what this video is all about. We are going to look at historical precedents, where we are in this cycle, and sectors you can position yourself in for the next rally. Let's get into it. Every generation gets one of these moments, a technology so revolutionary that it literally blows the mind of everyone, investors, users, basically everyone around, and then crash. And softly, silently, the technology becomes one of the backbone of human civilization. It has happened over and over again that we can see a trend here. First was the railroad boom. Railroads opened up the entire continent. They created modern commerce, modern cooperation, and even the modern stock market. Capital flooded everywhere, and everyone wanted a piece. Then in 1873, the bubble burst. A global depression followed, but the railroads became the backbone of the American economy for the next 100 years. The next time this same pattern showed up was in the 1920s. Electricity, automobile, radio, and consumer credit. America was being rewired. The stock market went parabolic, and then in 1929, another crash. The Dow fell 89% from its peak, causing another Great Depression. But electricity, cars, and radios, they became permanent features of civilization. I bet everyone knows the dot-com boom. The internet was the sensation. It was transformative, and everyone lost their minds over it. The Nasdaq rose over 500% in 5 years, then crashed 75% in months. Over $5 trillion gone. But a few companies survived: Amazon, Google, and by 2010, the internet had become the most important infrastructure in human history. And here we are. While several people believe that we are in two different timelines, the mega tech boom from 2009 and the AI era, I strongly believe that it is just an extended bull run right from 2009 to this very moment. They might quote the COVID crash as the crash of the big tech, but it's an argument I would love to have in another video, not this. To show you how high the market is, 9 out of the 10 largest companies by market cap have direct exposure to AI, and literally every company on earth now needs an AI strategy. If we are this neck deep in AI, how then can I assume that we might be headed for a crash? Well, the answer is seen in a phenomenon called the Gartner hype cycle. In the 1990s, a firm called Gartner documented what they noticed about literally every new technology up till that moment, and they called it the hype cycle. And it's funny because over 30 years after the research was made, the trend still holds. The cycle is split into 5 stages. First is the technology trigger. A genuine breakthrough happens, early adopters notice, the press starts writing about it, and at this stage, it is mostly niche. Then we move to the peak of inflated expectations. Now, this is where the narrative takes over. Everyone is talking about it. Investors pile in, and valuations detach from reality. The headlines are breathless, and this is where it's called the peak euphoria. From here, we move to the third stage called the trough of disillusionment. This is where reality arrives. Companies fail, earnings disappoint, and the bubble pops. The same press that was celebrating the new technology starts writing obituaries. This is where the carnage happens. From here, we move to the slope of enlightenment. The survivors figure out the actual business models that work. Real use cases emerge, quieter and more durable. And finally, the Gartner's hype cycle is the plateau of productivity. Here, the technology becomes boring infrastructure. Everyone uses it, and nobody talks about it as revolutionary anymore. Now, this is the crucial point. The technology surviving and investors making money are two different things. If you bought Amazon during its IPO in the 1990s, the company went on to be one of the greatest companies in human history. But then you would have to wait 10 years to break even. Now, where are we in this cycle? The S&P 500 is more concentrated today than any time in history. The 10 largest companies now make for 41% of the S&P 500. For context, the peak of the dot-com bubble had 10 companies making up 27%. And what makes this different is that the 10 companies are not so much different. Across board, they are tied to one thing: AI. This means that the entire S&P 500 is just a one-directional bet to AI making it. But someone says, wait, during the dot-com bubble, companies were not profitable. And you're right. Today's mega companies are extremely profitable. Strong balance sheets, real earnings, and real cash flow. And it's interesting that while the top 10 companies make up 41% of the S&P 500's market cap, they also make up about 32% of its earnings. But here's the problem: capex is about 75% of these companies' cash flow, similar to 1999. And at a point in this cycle, these companies would need to justify the spendings through real earnings. Apple and Microsoft recently announced up to a 15% increase on the price of their product, and it seems the strategy here is pushing those costs to the consumers. Companies like Oracle and a few others might not be able to take that approach, but it'll be interesting to see how they play out the game, seeing that most of their capex is through debt. What actually breaks this? There are a few triggers that could cause a crash in the current AI ecosystem. The first, chip crisis getting worse. So in Q1 2026, memory prices rose about 98%, and analysts don't expect meaningful relief until 2027 or at most 2028. If AI infrastructure cost keeps consuming chip supply, more tech companies get squeezed. At some point, the cost of building AI starts eating into the returns from it. Then we might also see where's the revenue moment. Companies are spending trillions building AI infrastructure, data centers, and the likes. But enterprise AI pilots have been so slow to translate into measurable revenue growth. There will likely be a moment when the market asks, where are the returns on all these investments? It brings back memory of Meta in about 2022, 2023, thereabout, when they doubled down on their metaverse project. At some point they had to choose between continuing down the rabbit hole or doing what investors wanted. So at some point in this AI cycle, also, we might get a point where the question now starts popping out: where's all the money we are spending? And companies will need to choose between regulating or reducing their AI spends or doubling down on the project. There's also a chance that we see commoditization from competitors. We saw this in 2025 when DeepSeek released a model comparable to the best American systems at a fraction of the cost. The market dropped sharply. Now, if the core AI products get commoditized, the moats that justify trillion-dollar valuations disappear overnight. The important thing is that it is never one trigger. It is usually a trigger coming up when the market is overextended or over-concentrated. What do you do with all this information? Well, I have to tell you, I'm not saying, go all out on cash and just wait. The important thing is the market can stay irrational longer than any investor can stay solvent. But there are a few ways you can play this game smartly. So the first thing is to look outside the US. I've been telling people in my close communities that I'm exploring opportunities in places like Japan, places like China. Most of this problem or most of this bubble is US centric, and emerging markets often offer a way of escape when the US market is tilted. A much simpler approach you can take to this is choosing the peak and shovel stocks. Now, I have a video on this. You can watch it after this. For the AI boom, people really think that the pick and shovel stocks are the data centers, cooling system, and a few things like that. But if you check those also, they are overextended. So how can you better play this? Well, there's no one answer for it, but then you should look at critical infrastructure that are not well known but could cause huge bottlenecks. Things like bushings, things like GOES. Yeah, so these are important infrastructure in the whole AI ecosystem, but they are still less known. I think the last suggestion is to look at defensive stocks. There are some companies that no matter what, they are not really affected by AI. So healthcare, utilities, consumer staples, just a few stocks like that. Yeah, so you can look to buying them more often than not at the peak of a bubble. These stocks underperform. So when everything goes down and crashes and we're trying to find a reset, these are the stocks you are better off holding. Now, are there sectors you should watch out for the next rally? Well, yes, there are some sectors that you could look into for the next rally. A few of them include commodities. Now, one of the critical infrastructure for AI, and mind you, while I said it's possible for the current AI bubble to crash pretty much soon, it's also important to note that the technology would not leave. It's just the overhype and the excessive sentiments around it that would likely need a reset. So, looking at commodities, things like steel, things like aluminum, these are a few things that are critical parts of the AI ecosystem, and they will remain here. And if you feel okay, you don't want to do all this, a very simple way is to go long bonds. Buy bonds. There's no other way to it. The 5% annual yield and stuff like that. Just buy bonds and keep. If okay, you want to just get out of stocks altogether. For the meantime, just buy bonds. And that's that about that. I'm really eager to see what the world will look like in the next 20 years with AI all around us, and it'll be interesting to see. I know you're looking forward to it also. If you love this video, don't forget to like, subscribe, and share. It might mean little to you, but it means a lot to us. Thank you, and see you in the next videos. Cheers.